Welcome to this explainer. Look, today we're unpacking a truly monumental shift happening in the financial landscape right now. We're talking about the definitive end of the Powell era at the Federal Reserve. And here's the thing, institutional investors, they aren't waiting around. They are already aggressively front-running the 2027 regime. We're basically walking away from this long era of consensus-driven pragmatism and stepping straight into an environment of serious structural volatility. If you're holding a standard fixed income portfolio right now, the rules of the game are literally changing right beneath your feet.
To really capture the urgency of this moment, think of it this way. Jay Powell is leaving the building, and the bond market absolutely is not waiting for his replacement. It's already building the framework and pricing in all that 2027 volatility. That cozy era of data-dependent pragmatism we got used to is closing. We're entering a definitive lame duck period, and if you look at historical data, this creates a massive spike in the urgency for financial planning. The market hates a vacuum, right? And it's aggressively repricing the Treasury term structure as we speak.
Okay, so let's just dive straight in and ask the most critical question facing your fixed income strategy today. Is your portfolio actually prepared for the 2027 regime? Because if you're just sitting back, waiting for this neat, predictable little series of terminal rate cuts, you might be walking right into a trap.
Here's our roadmap for today. We'll quickly cover the lame duck volatility, historical transition yield traps, front-running the Warsh premium, the high-yield coupon trap, and finally, mathematical portfolio immunization. Let's get to it.
Starting right off with Section 1, the lame duck volatility.
Now, historically, the bond market always loves to test the resolve of a new Fed chair during these critical transition windows. It's kind of like a substitute teacher walking into a rowdy classroom, you know? The market wants to see exactly what it can get away with. Whether we're looking at the handover from Miller to Volcker back in 1979 or Yellen to Powell in 2018, the market demands a premium. They completely strip away that certainty premium of the outgoing leader and aggressively probe the new chair. They want to find exactly where their pain threshold lies. Which brings us right into Section 2, historical transition yield traps.
Guys, this is a brutal trap for anyone stubbornly positioned for a lower for longer narrative. Just look at the Volcker precedent in '79. The two-year yield surged an astonishing 288 basis points in just 3 months. Insane, right? But even if we just look at modern transitions, stripping away that certainty pushes the two-year yield up an average of 55 basis points and the 10-year up 48 basis points in the first 90 days alone. To put that into perspective, a 50 basis point spike can literally wipe out an entire year's worth of yield in a matter of weeks. If you get caught on the wrong side of duration here, your capital losses are going to be severe.
And this yield shock? It severely spills over into equities. According to Barclays' analysis that spans nearly a century, the S&P 500 plunges an average of 16% within 6 months of a new Fed chair nomination. We saw this exact phenomenon play out in the fall of 2018 when the market tested Jerome Powell. He signaled we were, quote, a long way from neutral, and the S&P dropped roughly 19.5%. Equity markets will aggressively probe the limits of the Fed put, and that results in extreme historical volatility.
Let's move on to Section 3, front-running the Warsh premium.
So while retail investors are just sitting on their hands waiting for rate cuts, institutional desks are busy structurally repricing assets around what they're calling the Warsh premium. The market views Kevin Warsh as being highly focused on shrinking the Fed's balance sheet and rolling back central bank overreach. And think about it, when the Fed suddenly stops acting as the guaranteed buyer of last resort for long-dated treasuries, the term premium inherently expands. Investors suddenly demand way more yield just to hold long-term debt simply because that artificial central bank suppression is gone.
We're looking at two completely different worlds right now. Retail is totally stuck on the old playbook. They're chasing nominal yield, assuming the Fed will just magically cut rates and lift all boats. Institutions, they're executing a full 180-degree turn. They are actively front-running this Warsh premium, bracing for a loss of central bank independence and hedging against the political risk premium by immunizing their portfolios against sudden yield spikes. If confirmed, the policies associated with a Warsh regime structurally bias the market in 4 very specific ways. First off, it's structurally bearish for non-yielding assets like gold, which tends to drop when a hawkish reality sets in. Second, it biases the US dollar towards strength because of a shrinking global dollar supply. Third, we see severe yield curve steepening at the long end. And finally, an increased political risk premium gets priced directly into sovereign bonds. It's essentially an independence tax demanded by investors who are suddenly very wary of shifting Fed mandates.
Okay, let's hit section 4. And pay attention because this one catches a lot of people. The high-yield coupon trap. Far too many retail investors are currently sleepwalking right into an 8% coupon trap. They see a high-yield junk bond offering this juicy nominal yield, and they just jump right in. But what they're completely ignoring is the historical reality that when a new Fed chair is tested, macro-level shocks happen. And when those shocks hit, aggregate default correlations absolutely spike. Put simply, companies that seem totally unrelated to each other suddenly start failing at the exact same time, all because the systemic liquidity they all rely on suddenly dries up. The statistics around this are genuinely terrifying. Look at late 2025. Over half, 52% to be exact, of all high-yield defaults were actually distressed exchanges. These are quiet, behind-the-scenes debt renegotiations like maturity extensions or principal haircuts. They rarely make the front-page news, which creates a massive false sense of security for everyday investors. But here's the brutal reality. 35% of those distressed exchanges just end up in a hard default a few years later anyway. They're just kicking a very, very expensive can down the road.
And this, right here, is exactly why chasing that yield is so incredibly dangerous today. Average credit spreads are hovering around 2.9%. That is dangerously close to their historical low of 2.4%. Meanwhile, actual default risks are climbing. So as an investor, you are simply not being compensated for taking on the immense risk of a leadership transition shock. You're basically picking up pennies in front of a steamroller. The tiny bit of extra yield you're getting is virtually nothing compared to the real systemic risk of default.
So, what do we do about all this? That brings us to our final section, mathematical portfolio immunization. Think about it. If cash loses to inflation and long bonds and junk bonds are a trap, what is the smart institutional move? For years, the yield curve was inverted, screaming recession. Now the 2-year, 10-year curve has uninverted to a positive 0.47% spread. But make no mistake, this isn't just a friendly, normal rate cut environment. It's a hybrid steepening, driven by investors demanding much higher long-term yields. In this specific environment, institutional managers completely abandon chasing yield and instead shift to a highly precise mathematical strategy called duration matching to protect their capital. It works almost like a vaccine for your portfolio. Step 1. You calculate the modified duration of your bond assets, which is just a fancy way of measuring their price sensitivity to interest rate changes. Step 2. You calculate the duration of your future liabilities, like, say, the exact timeline of your planned retirement withdrawals. Step 3. You match them up. By perfectly aligning your asset duration with your liability duration, you completely neutralize the capital losses that are statistically guaranteed to happen when transition yields spike. You essentially become immune to the price volatility, meaning you can actually sleep at night while safely collecting and reinvesting your cash flows. So to quickly summarize the institutional alpha we've gone over today, you need to brace for that historically proven 16% equity volatility window. You absolutely must reprice the term premium, because the era of the Fed put suppressing long-end yields is over. You have to aggressively avoid the 8% high-yield trap driven by those hidden default correlations. And most importantly, you need to actively utilize duration matching instead of just passively sitting in bond index funds and hoping for the best.
Look, as Jay Powell prepares his exit and the Fed undergoes this monumental leadership transition, the market clearly isn't waiting. It has already built the framework for the 2027 regime. So the big question is, will your portfolio be a casualty of the transition, trapped holding the wrong duration and chasing bad yields? Or are you going to adjust your strategy today to be an immunized survivor? The transition shock is coming, for sure. The only question left is which side of the trade you're going to be on. Thanks so much for joining me on this explainer, and keep learning.